The game plan moving forward, let's talk about that real quick. And by the way, like, if you didn't know it, we're navigating this shit in real time. This is unprecedented market conditions. Things are changing left and right. So the only reason we're surviving is because we've been looking in the right areas and keeping track of the right things. So we're going to go over this real quick. And I think it's pretty clear to me what is going to be on the slate for the rest of the week after considering the following factors. But first, let's go ahead and look at what changed since the last FOMC meeting for any new members who may have came in and for anyone who may be confused as to what's going on. So things that have changed since the last FOMC meeting, and these are huge relevant things. We're going to be talking about two things straight out of the Options Clearing Corporation. They are the buyer and the seller to every single time you execute a trade. So again, this is very relevant. First, we have a entirely new margin methodology that was approved for incorporating variations in implied volatility. Now, implied volatility, I can go into that on a different video, but there's stuff all in the Discord that teaches about IV. Basically, IV is typically lowest at the money or closest to the current price, but what we've been seeing is the lowest IV out deep in the money. Deep out of the money for calls and deep in the money for puts. And then we also had a change to 1 multiplier options, which is a 0.01 index option like SPY, where you can put increments of 0.01 in for your bid order and such like that. This came out actually yesterday. This is filed an immediate... No, this is actually proposed. This is not immediate, so this will have to run its course through the SEC rule policy. So I'm going to go over these briefly real quick. First, the new IV policy. So if you didn't know, OCC is a central counterparty, or CCP, which basically means it interposes itself, again, as the buyer to every seller and the seller to every buyer, what I said a second ago, for financial transactions. And because of them doing this, they pick up a certain degree of risk and exposure to their members that use their clearing services. And this is especially considering the risk of one or more of its members may fail to make a payment or deliver their securities. So that risk OCC assumes. Now, they address this risk and exposure in part by requiring its members to provide collateral, including margin collateral. Now, margin is the collateral that the central counterparties like OCC like to collect to cover potential changes in a member's positions over a set period of time. Typically, margin is designed to cover such exposures during normal market conditions, which means that margin collateral should be sufficient to exposures at least 99 out of 100 days. So again, other central clearing counterparties are right now the Fed and the repo, the NSCC, and the Bank of New York Mellon actually provides it for the FICC, the Fixed Income Clearing Corporation. And then, of course, for options and anything options related, it's the OCC. So they're going to be doing three things with this filing, basically. They're going to be implementing a new model for incorporating variations and implied volatility within stands, which is a specific model for IV, for products based on the S&P 500 index specifically, and such proposed model being the S&P 500 implied volatility simulation model. They're also going to implement a new model to margin futures on volatility indexes, such as volatility index futures, such proposed model being the volatility index futures model. And lastly, they're going to replace OCC's model for margining variance futures, such model being the variance futures model. Now, the reason why they're doing this, there's three main limitations right now that they are telling you about in this filing. Number one, volatility of volatility forecasting. Number two, volatility surface discontinuities. Jesus, I'm retarded. And three, arbitrage constraints and cross-product offsets. Discontinuities. There we go. Discontinuities. Volatility surface discontinuities. Sorry, I had to say it right. So those three things, I'm going to go into more detail on what those three things mean, but those are the three things that they're concerned about. And then lastly, arbitrage constraints, of course, and cross-product offsets. So they're going to also, this is important, they would continue to use the current implied volatilities scenarios model for the products other than S&P 500 based products. This is essential to understand. So don't head into a trade with the new mindset of the new model if it's not an S&P 500 based product, because it may not work out for you. So these three things that they're concerned about. Number one, volatility of volatility forecasting. In the current implied volatility scenarios model, the one that they're using for everything else other than the S&P 500 components moving forward, they use what's called as a GARCH model to forecast the volatility of implied volatility risk factors. OCC's past analysis has demonstrated that the volatility changes forecasted by this current model were extremely sensitive to sudden spikes in volatility, which at times resulted in margin requirements that OCC believes were unreasonable. The current setup also relies on an exponentially weighted moving average of forecasted volatilities over a specified look-back period to reduce the model's sensitivity to large, sudden shocks in market volatility. OCC stated that reliance on an exponentially weighted moving average reduces and delays the impact of large implied volatility spikes, but that it does so in an artificial way that does not target the limitations and issues with the model noted above. So that's the first thing they're worried about. Now, to remedy this solution for the first issue in the proposed model, they're going to forecast volatility for the S&P 500 1 month at the money implied volatility based on the 30-day VVIX SIBO's option implied volatility of volatility index. So this may be something that you want to put on your watch list, VVIX. They're literally going to be basing their entire volatility for the S&P 500 1 month at the money, and keyword 1 month, to the VVIX, SIBO's option implied volatility and volatility index. So that's critical information. Definitely put this on your watch list. Now, OCC would further smooth the daily 30-day VVIX to control for pro-cyclicality. Now, OCC asserted that based on a performance analysis, the proposed S&P 500 IV model would, number one, provide adequate margin coverages for both upward and downward movements of implied volatility over the margin risk horizon, and two, it will remain stable across both time and low, medium, and high volatility market conditions. So that's also important to note. Now, number two, volatility surface word. The current implied volatility scenarios model relies on a nearest neighbor method to map the implied volatility surface between reference points. Nearest neighbor, the cheeks. It's all the cheeks. The smile is the trap. The cheeks are the neighbor. I don't know. Now, the reliance on a nearest neighbor method introduces discontinuity in the implied volatility curve for a given tenor. Further, the current implied volatility scenarios model, use of arithmetic implied volatility, returns can result in near zero implied volatility in simulation scenarios, which OCC states is unrealistic. 0% IV. I would agree. Now, additionally, the current model includes implied volatility scenarios for call and put options with the same tenor, which is basically the same expiration, and strike price that are not equal. A lot of you in the group have noted this observation. This is a problem for them. And this contributes to inconsistencies in the implied volatility scenarios. Now, to remedy this, of course, OCC now proposes to model the implied volatility surface directly to generate a surface that would be smooth and continuous in both term structure and moneyness dimensions. Modeling the implied volatility surface directly rather than mapping the surface based on a series of reference points would simplify OCC's margin methodology and help avoid the word discussed above. Now, Supernote 26 here, the implied volatility scenarios models a volatility surface by incorporating 9 risk factors based on a range of tenors and option deltas. And the delta, of course, of an option represents the sensitivity of the option's price to the price of the underlying security. So basically, the current IV model scenarios includes scenarios for call and put options with the same expiration and strike that are not equal. This is a problem, and it contributes to inconsistencies. Solution for this: Basically, I think I already went over this, but again, they will be smoothing this out and make it continuous, and they're going to be modeling this directly rather than using reference points to simplify their methodology and help avoid the problems. And then lastly, arbitrage constraints and cross-product offsets. Now, the current implied volatility scenarios model does not impose constraints to ensure that simulated services are arbitrage-free. Further, the current implied volatility scenarios model may not provide natural offsetting of risks in clearing members' accounts that contain combinations of S&P 500 options, variance futures, and or volatility index futures, because OCC models such options and futures independent of each other rather than as inherently related components of a broader system, which could in turn result in unnecessarily large margin requirements of certain clearing members. Now, the remedy for this: under the proposed model, put and call options with the same expiration and strikes would have the same implied volatility scenarios. Imposing such a constraint on arbitrage would be sufficient to allow OCC to use the output of proposed model for margining volatility index futures and variance futures. Use of the proposed implied volatility simulation model as an input to margining volatility index futures and variance futures would also, in turn, support margin offsets between S&P 500 options, VIX futures, and S&P 500 variance futures. So again, this shit is very relevant. Now, on top of all that, there was also a change to one multiplier options that just was proposed yesterday. This one isn't in the approval stages yet. It was just proposed. But in short, index option positions other than over-the-counter index options, which have an exercise threshold amount of 0.01 per contract, will be deemed automatically exercised if the option is in the money by $1 or more per contract on an option's expiration date. This is critical to understand. So I would take note of all this. If you trade options, this is relevant. Whether you like it or not, no matter how complacent you've become, this is relevant. Now, on top of this, I took an excerpt out of the economic outlook statement because what do we have tomorrow? We have GDP. And I've been trying to figure out where the hell is the market going to go tomorrow. There's still a lot of fuel left in the tank. Clearly, the governor that gave the speech on the economic outlook is very, very bullish on the outlook of the market. And he doesn't really put much weighting on the GDP. Now, take that with a grain of salt. I don't know how much his opinion weighs into all this, but I know his opinion does matter because he did issue the economic outlook statement. And it basically says, past experience has shown that job creation and the unemployment rate are timely indicators of a recession, more timely than quarterly GDP. That's just more timely than quarterly GDP. I will watch all the data carefully, but the factors I just cited, along with the evident strength across different measures of the labor market, leave me feeling fairly confident that the U.S. economy did not enter a recession in the first half of 2022, and that the economic expansion will continue, with, of course, a few downtrends here and there. So once we look at the charts and we look for the gaps to give us some form of guidance and direction, what do you know? There's a 1 penny gap left on the 1 minute time frame from 406.45 to 406.46. Based on this fact alone, and based on the short interest settlement window opens up this Friday, I would imagine tomorrow may be somewhat of a continuation of today, and then a relatively flat day after that, and then I'm considering it potentially finishing off tomorrow. But it's all going to depend on this gap, because again, if you gap this final upside gap that's within our current daily RSI range, and you map the distance from the candle to the distance from the RSI to being overbought, it matches fucking exactly, which is exactly how I played today. So, as retarded as that may sound, this RSI down here becomes oversold the second that we fill this gap. Now, is that a coincidence? I don't think so. So, in my opinion, I'm going to be holding out for that 406 marker tomorrow, and that is when I will go puts for the following week. Maybe even Friday. Again, short settlement window is going to throw a monkey wrench in there. So we may get a pop within the downtrend, if that makes sense. But I think tomorrow we finish it off, and we may end up somewhere up here at some point, which is when I will consider my entry for puts. So that's what I'm thinking for tomorrow. Hope that answers your question.